Okay, very good morning. It is Tuesday the 17th of April. So getting you up to speed with what's been going on overnight. Quite a few headlines to get through. And overall a positive market open for European trade this morning. European indices relatively flat, but a firm finish on Wall Street last night. So we'll have a look at some of the reasons behind that. A bit of an update on various different types of geopolitical news. And then as per usual, I'll hand you over to Sam for the technical look of the day. But just looking at the charts first of all, probably the most clear move that you're seeing already this morning is a bit of dollar weakness. The Dixie's down about 0.2%, so consequently both major pairs in the top left corner higher this morning. Euro dollar sitting just above its R1, cable just testing up at around that level, but cable above a 144 handle, so the resurgence of the pair continues. And we'll have a look at a little bit of reasoning of why the move kind of reinitiated yesterday on the back of a few articles of interest regarding Brexit as well. So let's get straight into the stories, and first of all showing you this, what a difference a week makes, because if you think about the last kind of 3 weeks, I guess we've had an episode of a short-term correction kind of evident in the US equity markets, but generally globally, whether it was trade wars initially that was the initial catalyst for that sell-off. Well, initially it was the wage fear, which hasn't quite materialized. That's going all the way back to the beginning of February. Then we had the trade war situation. Now we've got the latest, which is the Syrian-Russian conflict. But as we're going to go through in the next kind of 20 minutes or so, a lot of this has started to de-escalate to quite a substantial degree, and this is what we've been seeing in the equity market. So last night we finished up about 0.8% in the S&P, kind of similar gains in the Nasdaq and the Dow. But this is a look at the SPOOs, and as you can see, the record high that we printed just before the big sell-off that came after that wage number of the early February release of non-farm payrolls and the subsequent big sell-off that we had on the following Monday. We had the double kind of test at around those same price points on the downside. However, if you look where we are at the moment, we're now back to gains for the year. If you look at it from where we exactly started all the way back in the new year. So, those kind of fears that were looking like they were materializing, that big technical test at that level, which we tested at the beginning of February, has failed so far. And from a technical point of view, I know Sam will look at this more, but this was an interesting thing that I saw from LPL Financial, which they tend to look at statistics quite a lot in terms of their technical analysis. And I just thought this was quite interesting, and a couple of points to look at on this S&P chart. The 200 DMA, something which you guys are very familiar with because we've looked at it through the course of that retest that happened back in the beginning of April. But the average of the closing prices for the previous 200 trading days, quite a nice way to assess the longer term kind of technical trends in the market. The point though that this research firm are making is they're looking, as you can see there is a volume kind of profile at the bottom. What you've been seeing is declining volumes. If you just X out that one blip of high volatility and volume on that date in the middle. But if you go across and drawing a trend line, you'd say it's lower volume as time has gone on. The last time we saw market volatility similar to what we experienced in Q1 of 2018 was during the summer of 2015, and you'll know that period well if you were trading. That was when we had the fears of a Chinese hard landing. Volatility had spiked at the time. But what this firm is suggesting is that they're seeing signs at the bottom could be near completion. Additionally, the S&P 500 recently tested the early February lows, so obviously looking at this point here, but did so on lower volume. And this appears to be perfectly healthy market behavior, as we tend to see tests of lows on lower volume. Taking this a step further, they say they found that there have been 11 other times since 1991 that the S&P 500 tested recent lows, or this double bottom which has formed here. And they say we like to see lower volume on test of lows, as it shows there isn't the same level of extreme selling as seen as the earlier bottom. Thus the sellers are starting to dissipate, starting to dry up. Not only that, they say they're seeing what they classify as a buying thrust at major lows. What this is, they're saying a buying thrust is an uncommon signal that occurs when nearly all stocks go higher for multiple days. So if you actually go back on April 3rd and 4th, the ratios of the number of S&P 500 stocks higher to lower was 10 to 1 and 7 to 1 respectively. So this strength could be a good sign, but the fact that it also took place at the 200-day moving average and early February lows makes it even more compelling. And this report goes on to look at the statistics about when you've had this buying thrust take place, the kind of positive returns that you see over the period thereafter when this type of activity has occurred on previous occasions. I have sent this out to you. It's in your inbox if you want to have a further read. Certainly those of the mindset, or the question I should say, of is buy the dip strategy still valid? Well, if you read this, you're certainly going to be more thinking of that mindset of the arguments they put forward. But as we know, markets aren't just based on technicals. There are fundamentals to consider, and certainly, as I'll discuss in a second, the geopolitics has de-escalated. But this firm also notes that while valuation, so looking at a more micro fundamental level, may be somewhat elevated, a lot of talk, of course, when the first correction took place was about the overstretched nature of single stock valuations. But they say while that might be elevated, when factoring in the historically low inflation and interest rates, they're not concerned with the price to earnings ratios. The fundamental backdrop continues to be quite positive, and we are not seeing any signs of impending recession over the next 12 to 18 months. So this, in tandem then with these technicals, give them quite a strong argument about they continue to expect potential double-digit stock returns for the year, led by small caps, value, and emerging market equities. So, of course, my job here is to present you with the news. I want to remain fairly unbiased, because just as much as this kind of talks up the prospect of potentially higher long-term gains for the equity market, and this level potentially in the technicals providing a signal on this side of potential bullishness, of course there are those in the market which will also be talking the other side of the book. And so just for the sake of giving the bears an equal argument, this is something which I saw just drop down on my Twitter feed. Now, I'd say this is probably less compelling because it takes into account a big hypothetical period of what if going over the foreseeable future, and as we've seen with the charts this morning, we're recovering at this point, which would be against this materializing. But there's one particular study from a bank talking about if things remain equal to some recent price activity, what we could see, focusing again on the DMAs, is the 50 moving average dropping below the 200, which is typically known as the death cross, and that their timings would suggest that this could happen on Memorial Day, which is at the end of May, so in the coming kind of weeks. This, of course, if the death cross were to materialize, would be a bearish technical indicator if that trend persisted. So, just to talk an even book here, that's something as well which I've seen, but I thought the other research was very interesting, and as I said, that is in your inbox. Looking at this overall risk appetite, though, that's apparent this morning because equities generally, especially US futures, higher. You've got T-notes lower, gold also marginally lower, albeit fairly small, about $2. So run through of the headlines. Trump scraps new sanctions against Russia, overruling advisors. Now, obviously, this time yesterday, I was kind of putting forward my view about I can't really see just financially how Russia can be too aggressive in the political side of the response to the Syrian strikes that occurred at the weekend. What's important then is, does this escalate, or quite the opposite of which is actually what we're tending to see because of this type of commentary. So Trump, much like we heard at the weekend from the likes of Mattis from the US side, but also the foreign secretaries from the likes of the UK and France and so on, not looking to repeat the action that's taken place, more of a one and done. Trump also going as far as scrapping any new sanctions, which is against what he's been advised, such as the nature of kind of what Trump tends to be like. So quite interesting. This type of thing definitely is a market friendly type comment, but as we'll see in a second, what Trump says does tend to change pretty quickly. Before I get to his tweets, Quick look at this though. This is another interesting thing, which is kind of on the back burner. I'd say on the geopolitical front, this is below definitely the Syrian situation, but definitely something people are still monitoring. If we were to go back to last summer, this was the main narrative, and now it seemingly has dropped off considerably. But overnight, there has been discussions. Reports suggest that North and South Korea are discussing plans to announce an official end to military conflict. You know, this is quite unprecedented. Let's not forget, your sign of coming to the table to talk and a commitment to make an agreement to end the war is one thing. That coming to fruition and actually happening is completely another. But certainly, from the point of which Kim Jong-un left North Korea for the first time since taking power in 2011, going to meet China and their president Xi Jinping, now looking to meet with the South in order to talk about complete end to the conflict. You know, this definitely would be a positive in that harmony of the East Asia and the Korean Peninsula in that respect. So this also has changed quite rapidly in that sense. But as I said, you can always rely on Donald to keep your life, keep a little bit of spice in your life, because he's come out and tweeted Russia and China are playing the currency devaluation game as the US keeps raising interest rates. This is not acceptable. So yeah, he's kind of, you know, Trump. This is what's interesting from a political point of view. If you're trying to appease the general mass population of America, you know, how many middle Americans are monitoring the official kind of trade negotiations, the NAFTA talks, the sanctions and the type of sanctions he's looking to impart on Russia and what types of companies and individuals, or what is it middle America doing, seeing what he says on Twitter, because that's what gets plastered all over the press, you know. And it's quite interesting to see. Trump is almost kind of like Harvey Two-Face in Batman, where he's got this really aggressive stance which is kind of for the masses, and then when it comes to the actual negotiation side, it's a lot more even-handed. But that's not what the average Joe on the street sees in America. So not to read too much into it, but there's a definite clear divide in his tactic, I think, from the medium that he uses to communicate. So this isn't, I would say, spooking markets at the moment, because what the markets are concerned about are these types of comments. What's the nitty-gritty that could promote then a retaliation from the likes of Russia? This would say the chances of that have fallen because of this type of lack of want for further military action or indeed sanctioning. Okay, other headlines to be aware of. This is again more positive news, you could say, which is helping the short-term sentiment, at least intraday. And a lot of people might have been mooting the point, and certainly this was I guess a talking point, I'd say, at the beginning of the year, was if you start trade talks with China, well, China's the biggest buyer of US treasuries, so by net default they own most of the US debt, which if the US are looking to do large-scale government spending, needs to be financed by large amounts of debt, which if the fiscal situation is worsening, i.e. the accumulation of this debt is outpacing economic growth, well then who wants to buy the debt? And this is kind of, has this then given China more leverage at the table for things like trade talks, given they're the biggest holder and buyer? Some might have feared, and there were some source reports a few months ago suggesting that China won't end purchases, but they could taper the purchases down. But quite the opposite, in fact, in the latest data that came out last night, because what's happened is that China has expanded its US Treasury holdings in February, despite escalating trade tensions. China, the single biggest foreign holder of US government debt, so to put a couple of numbers behind this to add a layer of context, they added $8.5 billion to its Treasury holdings in February, taking its total holding to $1.18 trillion. Some analysts, of course, fretted that the country could try to use its position as Washington's biggest foreign creditor as a leverage in a standoff. However, this is the important part to keep in mind, and why I would say on the balance, most don't see China just all of a sudden selling treasuries en masse, because China's treasury purchases are driven by its trade deficit with America, and using dollars acquired from the sales of goods to the US to buy bonds, and any move to sell or even halt purchases would hit the value of China's large portfolio of US government debt. So it's kind of against them if they start selling. It doesn't make any sense at all financially, other than a threat in order to get the US to do things like, I guess, get on side on the Korean issue, on the trade issue, the political issues, and so on and so forth. To give you an idea, if you thought people were stressing about this fiscal situation in America being bankrolled by ever-growing debt, well, according to the last data, in aggregate, $43 billion was added to foreign portfolios of buying US debt, which is the second straight month of positive flows to purchasing US government bonds. So, we're a long way from people losing trust in the biggest creditor in town at this point. So yeah, I just thought that was interesting, and again goes to show that despite all the hot air flying on the trade war front, China's still buying treasuries, still the biggest holder, as are other investors too. Talking of China, more positive news, because if you were monitoring the economic prospects of China, I know this isn't really, I would say, high on the agenda of global macro at the moment, but China's economic expansion held up amid robust consumer spending, underpinning global growth and giving authorities room to purge excessive borrowing. And so overall, the data was in line, but shows still robust levels of growth. So that was good for China in the data overnight. And then the other thing that's been happening is oil prices continue to rise. What we've been seeing here, and this is kind of something we touched upon yesterday, is that I do feel that although US rigs have been jumping by quite high margins in a fairly consistent fashion, which would mean that as a net effect US output will also subsequently increase, I do feel though that this is being outweighed by A, global economic prospects still continuing to improve, but B, more importantly, OPEC's commitment to continue to cut production. Kuwait, you'll know Kuwait because if you know your OPEC members, these are the fourth largest producing nation within the group, and they've said they're to consider extending output cuts into 2019. So the chorus continues to grow strong that these OPEC cuts will be rolled again. I think this would be the third time, if not the fourth time. They continue to keep that in play, even though this is what we're seeing. US crude oil inventories continue to be below the 5-year average. So has the glut vanished? So if you were looking at look how oversupplied the market was just going back even a year ago. We've completely rebalanced in the market. So these factors, I feel, although it has de-escalated short term, still growing tension, particularly in the Gulf amid Saudi and Iran, which is always a very hostile relationship, I think will help keep oil elevated. So even if we were talking medium term to get a bit of a pullback from the current prices, given how quickly we've risen, I do think that prices look pretty solid at a 60 price point at the moment, and if not to go higher, talking medium term. Okay, a few other things. More positive news here. You've got Netflix. Remember the FANG stocks? Everyone was panicking about FANGs only a few weeks ago. Well, check out the FANGs now. Netflix up 7-8% after market last night. Their net income up 63%. Incredible jump. International revenues exceeded sales from its home market of the US for the first time in the current quarter. Later, subscriber numbers, which is key metric for them, beat expectations. So a little bit of breath or sigh of relief, if you like, for the FANGs in the short term. And then got to talk about the pound, and this was something which was in circulation yesterday, so this isn't new, but it definitely, I think, just fits this ongoing picture that I think is very prevalent for the pound, and this is to do with the House of Lords is expected this week to vote for Britain to remain in the EU customs union, inflicting a damaging defeat on the government. What this means then is basically the Lords are expected to support perhaps a majority of more than 50 an amendment put forward by a former Conservative chairman calling for the government to negotiate an arrangement which enables the UK to continue participating in the customs union with the EU, i.e. blocking the government's current objective. This leading then to potentially a more softer type of Brexit, which ultimately is favourable for the pound. So long-term prospects for the pound still remain very bullish for the moment. In terms of looking at the pound here, this is more short-term, looking at the year-to-date. We've obviously managed to get up to these levels now at the 144 handle, above this kind of double top, if you like, that materialized very beginning of the year and then also late in March. But if you start looking here, it was that bigger break of the January move on the dailies that really opens up this move. And as I've said before, I really do feel quite of the belief that the only way is higher here in the long term. And I think that 145.60 would be a good target for the longs if you were holding up to the test of that previous April 15. This is a pre-referendum low that we had. But no reason, really, I don't think, well, you couldn't go beyond that. You've got the May interest rate hike coming up for the Bank of England in a couple of weeks' time. And then you've got the weakening, the persistent weakness of the dollar, which, if all things remain equal, I think the probability of this 4-5 rate hikes from the Fed this year, I think, has completely changed. And I think the Fed is still going to stick to this slow and gradual approach. I think is probably going to be the most likely outcome, which obviously plays in the hand of the longer term higher trend of cable. Okay, a few other things then, just to round off, and let me hand you over to Sam. For the calendar for today, a few things to be aware of. From the UK, back to data watching short term. You've got wage data coming out. Now this definitely can help this ongoing positive trend of cable, because this is what average weekly earnings growth has looked like in the UK. And as you can see here, really nice progressive improvement. We've gone through really the summer of last year and things have just got better and better. And if you remember, inflation has started to drop off its peak. So this divergent path of higher prices, lower wages, which has squeezed UK consumers, is now starting to converge, which is a positive signal and more likely to give freedom for the Bank of England to subsequently hike interest rates in a few weeks' time. Hence the market's priced in for that event. But looking at what's expected for today, we're looking for a 3% reading on this data. So we're looking for another increase on the same kind of steady trend that we've been seeing, which would be a net positive as well. If we get to 3% levels, this really puts us back up to the highs that were seen in 2015. Anything up and above 3.2% or higher, which would be, keep in mind, above the top end of the most optimistic estimate on Wall Street, that would put us up to levels which this is a really important point really for the wage component in the UK, is that pre-financial crisis, average weekly earnings growth was averaging really around 4 to 4.5%. Even though we've recovered post the worst part of the financial crisis, wages have only averaged about 2%. So net only half of what it was pre 2008, 2009. If we can start to break above this, that's a really positive signal for the wage sector, and then consequently for the household income situation for the consumer, which has been, of course, under pressure immensely over the last 12 months. Going back to the calendar, other things to be aware of: 10 o'clock ZEW. Remember, this is a soft economic indicator, forward-looking conditions surveyed from economists and analysts. So it's not quite as punchy as IFO, which is the same but companies' views. Nonetheless, I would keep an eye out for this, but I wouldn't be anticipating it really to move the market too substantially. I would, though, be keeping an eye on that wage data from the UK, which would be quite interesting. In the afternoon, US building permits, housing starts. Again, housing data, not so much of a feature, but later you get industrial production, 2:15, and then you've got your API inventories in the afternoon. But keep an eye in the afternoon for US Fed commentary. If you remember yesterday, I was pointing out the fact that you've got 10 Federal Reserve speakers this week. You've got 3 all clustered in the afternoon session. You've got Fez Williams, who is a voter, Quale, who's a voter, and then you've got Fed's Harker as well. So quite a few to look out for. So keep that as well in mind if you're thinking about strategies around those times. Cool. That's it from me. Let me hand you over to Sam then. He'll look at the charts and a couple of setups he's got in mind as well for the session ahead. But have a good day.
Yeah, good morning, guys. Just having a quick look over oil, just coming down not far off its low, having found decent support initially off that bounce. Let me just get that 15 minutes of what was the previous sort of low area, and I did get long off that. Got filled only, unfortunately, for one contract, and then took it off just before the previous area of support. Put it on Twitter, and actually someone else that used to do the course, Max, if you're still listening, good traders, I'm sure you're still short. He actually got short as I got out, so he took the other side of my trade, which was good. Where could this trade sort of go to now? I mean, you've come to a decent level of support from last night. Let me just remove this trend here, where we've had a bit of a bounce. The previous low could offer sort of resistance here, but gold coming down as well as oil, but found good support pretty much to the ticker around here. Hasn't quite made it up to the previous low, which could obviously be a decent area of resistance for that trade for gold. So one to keep an eye on as well. We saw the dollar weaken a bit this morning. We're just having a bit of a pullback this morning. Over the last sort of 15 minutes or so, pound hitting the R1 quite nicely and continuing this uptrend that we've had, keep breaking through the previous day's high. You can see here, once, twice, 3, 4, 5, 6, 7, 8 days in a row, continuing to push on and make a new high. Still having a bit of a pullback each day, but one's levels to be aware of, I think, to the downside here. Obviously the previous high that we did break through at 91 on the futures, and the lows of the day around 43.70, pretty decent level as well, just purely off sort of support and resistance levels that we've gone through. You know, would want to get in a couple of trend lines in there as well, for which levels could also offer a bit of support going through. You probably would want one. Let me just have a quick look. Using these lows up here. Could be later on looking at the previous high, this trend line. Something to bear in mind for later on after the data release, coming out in, well, just under half hour. Something to bear in mind there. 144 on the futures, just offering a bit of support for now. Euro as well had a bit of a breather, and you can see that's come down after the R1. Yesterday's high could offer potential level support, however it has already worked. You can see we did break through, and the classic worked quite nicely. So levels, if you wanted to be a bit safer, again, the previous high of the day, although that has worked on the pullback. So a couple strong areas of support once broke, resistance that once broke through, offered a good level of support for these markets against the dollar. But the dollar just trying to pair some of those losses early on that we saw. I think trend sentiment for the day at the moment has to be for the dollar weakness. But maybe waiting for a retracement might be the safer sort of trade for now. Really trying to identify where the best level for this could be. The level I have marked up for euro, and I put this all on my Twitter this morning, was using that 124.35 previous high of the day. You've also got a bit of a trend line coming up to that, so something to bear in mind. Aussie dollar. It's a tricky one yesterday. You know, it's just really struggling all day to push higher. Eventually did into the evening, but you know, nothing convincingly at all. When it broke the high, it was, you know, time to go to sleep really. So Aussie dollar finding a bit of resistance at R1. The dollar strengthening a bit as we saw across the board with euro and pound there. The pivot could be quite interesting. You know, half choppy yesterday would be the only sort of question mark around that. S1, which worked very nicely with yesterday's low from the afternoon. So that's a decent level of support. Whether we'll get down there, I think, remains to be seen. If you look at the range yesterday, it was very contained. The high of today, I think for that to sort of break through, you'd also want the highest, well, this area of sort of support turn resistance from Friday to also go. So stuck within this range, for now for Aussie dollar, and I think waiting patiently, playing the range for that particular market is the sort of the go-to there. I think that's going to be the focus. Dollar yen, which you can see just recovering a bit here as well. Probably worth having a trend line using the previous highs just to see if we are not far away from that. Let me have a quick look. Okay, not a million miles away from perhaps testing this to the upside. We've got previous sort of levels of resistance I'd want to bear in mind. Highs of the day and then the Asian session as we sort of come through. All potential areas to continue this trend, or if you do feel the dollar is strengthening, you're waiting for breaks of these levels. The key resistance point for me will be using this high, which was the support area from yesterday. I think one to bear in mind that as we're just seeing a bit of a retracement across the board. Equity markets obviously pushed higher yesterday, but it wasn't the easiest sort of trade to get involved in. It was very choppy, up down, really sort of getting squeezed in before we push through. And as has been the case for the last sort of couple of weeks, it's really been moving after the close in Europe into the sort of the evening, or the afternoon for the United States. Key level broken now for the S&P. You can see marked up there. You can see that, yes. 2680, around that, the high that we had on the 27th could be still a key level of support if we were to come back and test it. Previous highs from the sort of middle of March, other areas to bear in mind, and then the lows that we had back on the 20th and 21st, all potential targets that we may get into the afternoon. In terms of support levels, if you were looking to continue the trend, obviously as mentioned, you have this area that we had broke through yesterday, albeit quite choppy around there. Pivot doesn't look too bad. Previous high of the day kind of already worked, 26.88 and a quarter. That's something just to keep an eye on. Looking for maybe this trade to happen again into late afternoon might be the preferred option. You can see what's been happening in the morning. It's been pretty choppy. Maybe have sort of smaller profit targets in mind. Nasdaq and Dow quite similar in the fact that they have both pushed on, and you can see they're both very similar around just above the R1s, having used yesterday's highs as decent levels of support and the overnight high from the Asian session as well. Quick look over the DAX and FTSE. So DAX just finding a bit of resistance, didn't quite make it to the R1, but we're still the highest we've been for quite some time using yesterday's highs. So keep an eye on those levels to the upside for the DAX in terms of where we could get to. R1 really is in the way, and then you have obviously yesterday's high and Friday's high also to bear in mind. With the pound pushing on, you had FTSE really not knowing what to do, and it was a decent opportunity using yesterday's low to get long there as the pound perhaps found a bit of a breathing space using the resistance level. And with equities pushing on, the FTSE wanted to sort of join the part, and you've had a bit of a bounce since then. Whether we could see this market drive back up to what was yesterday afternoon's original low and then today's high, I wouldn't be so sure. You have some potential resistance on here on the CFD 7206, definitely a potential resistance area for anyone looking to continue this trade. I know a couple of people are currently long the FTSE using that low that we had from overnight. 7206, not a bad target for that market. Quick look back at oil just to see that, yeah, just having a bit of a bounce, nothing major, only 8 ticks from that sort of low. I'd keep an eye on that. Obviously you got yesterday's lows and then the low from the 12th to bear in mind. The bund, pretty sharp move lower down and has found a bit of support using quite a good price action area. Was the low of the 13th, and we found resistance before breaking through yesterday, and we're just finding a bit of support on that level now. So something just to bear in mind for any bund traders. Quite an interesting level was the low of the day there. Any questions, obviously, please do get them in the chat. Just having a quick look before we wrap it. Eurostoxx just trying to push on. Key area of resistance, though, using yesterday's high for that market, which means just to keep an eye on the DAX, as that's perhaps got a bit of catch up to do there. But yeah, any questions, please do get them in. UK data coming out in 21 minutes. Something to bear in mind. Usually can be quite a decent mover if wildly out of line. So catch you in the chat and hope you all have a good trading day.